Welcome to the Refinitiv Sustainability Perspectives podcast, where our goal is to engage and inform our audience, from investors to asset managers and portfolio managers, to sustainability leaders and those involved in ESG and sustainable finance. This is Kisa Shreen. Green bond issuance accelerated in 2020, reaching an all-time record of $76.5 billion. Now, driven by an increase in capital raising by sovereigns, multilaterals, and banks for COVID-19 relief and recovery efforts. The sustainability and social bond categories each surpassed $30 billion for the second consecutive quarter. Yet many questions still remain in this area, and one of them is measuring green bond premium pricing. To give us insight into this is Erlandsson, Executive Chair of Anthropocene Fixed Income Institute. Welcome back to the podcast.
Thank you very much. It's very nice to be back and discuss these really interesting topics.
So let's start off with, what are the main challenges when it comes to pricing sustainability bonds versus conventional bonds?
So there is a really core sort of difference in how investors see this and how issuers sees this. Obviously, we have the perspective that people are issuing bonds. They want to issue the bonds at the lowest possible spread or yield. So they want to pay as little as possible. However, that has the other side to it, that the fact that the investors, they want to see as high a yield as possible. And that becomes quite interesting in the green bond space or sustainable bond space, where investors would like to claim that they're not giving up returns. And issuers of these bonds, they want to claim that they are actually finding cheaper financing. So it has some really interesting implications of that basic difference of opinions.
And we also talk a bit about, or you discuss the concept of non-stationary green bond spreads. We know that data can be non-stationary. So what exactly makes a green bond premium non-stationary? Is this related to trends that may not be anticipated, such as what we would look at with non-stationary data?
Yeah, it's perhaps a little bit geeky, but it's really an interesting econometrics problem that has real implications for how you try to measure this. So to start with, we would assume that all bond prices or bond spreads are essentially non-stationary. They follow more or less random walks, which makes it hard to predict where bond spreads are going to be, a week ahead or a month or a year ahead. But this also then becomes an issue when you look at the green bond premium, because what we define as the green bond premium is really what's the difference in the price or the spread of a bond that is green vis-a-vis if it hadn't been green. So you essentially try to compare the bond spread of the green bond versus the non-green bond and say something hopefully intelligent around that. Now, the problem here, and where non-stationarity comes in, is the fact that if both of these bonds, so the traditional bond and the green bond, have non-stationarity in terms of their spreads, their time series, then you get into some econometric difficulties around measuring that. And that can be a little bit tricky. And I think we've seen in the literature that people have come up with some results that aren't entirely correct when it comes to some of the econometric conclusions you can draw from it. In particular, there is something called super consistency, which tends to be that you try to measure the green bond premium and you get extremely accurate results. You get very small standard errors in that, and that's a typical feature of non-stationary data. And unfortunately, that has made a number of studies, I think, draw two strong conclusions on that there is a green bond premium and how that actually looks. And we have tried to look at it a little bit further.
So that really, I think, leads very seamlessly into when you talk about looking at the green bond and the difference in the spread if the bond is green versus if it hadn't been green. We're hearing more about a concept introduced by Germany called the green twin bond. And the rationale behind this construct is to make sure that the issuance of green bonds don't negatively impact liquidity in German government bonds. So do you expect the green twin bond, the theory and the concept, to work? And why should this concept be adopted globally? And please feel free to talk more about what this is and how this is being unfolded in Germany now.
Yeah, so we wrote a paper back in the summer where we made an analysis of how we think you should look at the green bond premium from an econometric perspective, and it involves all these things, co-integration and vector error correction models and everything. But the basic preset that you have in that investigation is that it's very hard to find this sort of identical twin bond that you can compare your green bond with in order to find this difference in price that we try to measure in there. So hence, we actually called the paper even a twin bond approach on what we did there. Now, lo and behold, in August, Germany, the German Treasury goes out and issues what they're calling a twin Bund. So they have two bonds, one which is green and one which is non-green, and then they have identical structural features, and they have exactly the same maturity, the same coupon, and all of these other things that make otherwise bonds different from each other. And that gives us really a perfect laboratory in order to measure, are there other statistical properties or other properties of the green German Bund vis-a-vis the traditional Bund, and they are really what we call the identical twins, and that will give us going forward the opportunity to measure the difference in characteristics between the green instrument and the non-green instrument in a way that hasn't been possible before.
So let's talk a bit about the risk return ratios, and can risk return ratios reconcile that conflict that you talked about a little earlier between issuers and investors? They both have different desires, right?
Yeah, it's a rather interesting question, and I've been in the green bond space for a long time, and it's always entertaining to see these conferences where you have issuers on the one side claiming the lower cost of finance through the green bonds, and then the investors on the other side saying that they're definitely not foregoing any return because they are buying the green bonds, and it's just not intellectually coherent to claim both at the same time if you're looking at only the return dimension, because one making one more dollar is going to make someone else lose another dollar. However, how you can reconcile this is if we can see a situation where the green bonds actually have lower volatility than the traditional bonds. Now, start out and thinking about modern portfolio theory and everything that we learned in Finance 101, and you will realize that people are not buying a return, they're buying a risk return. So you take the return and then you divide it by some sort of measure of volatility. Hence, you can, like an asset with a 4% return and a 2% volatility, in the same way that you like an asset with 5% return and 2.5% volatility, because the risk return ratio is, or the return risk ratio is 2 in both of those cases. So you're almost indifferent between the two. So this gives us a little bit of a thinking when we look at something like the German Green Bund, for example. The German Green Bund came at a spread which was around 1 basis point lower than the traditional German bond that is outstanding there. So 1 basis point here is 0.01%. So quite a small difference, it might seem, but important for fixed income investors. Now, if it is the case that the green instrument also has a slightly lower volatility, then it's quite okay for the investor to have bought that, because they had a less volatile portfolio from buying that bond, although they had a slightly lower return as well. And the thing here that it comes down to is we can start measuring and looking at, the risk dimension. Do green bonds have lower risk, lower volatility than the traditional bonds? And does that stand in sort of proportion to, how much lower their potential yield or spread is vis-a-vis the traditional instrument? And I think this takes the analysis around the green bond premium to the next level.
So that's an interesting question. How can we determine? How can an investor determine that yes, in fact, that this green bond that I'm looking at or that I'm thinking about has in fact a lower volatility than traditional bonds? Aren't we at a bit of a disadvantage because green bonds are so new? So how are we looking at historical precedent to make that assumption, or what factors do we need to think through when we want to figure out whether this green bond or this group of green bonds has a lower volatility and a lower risk?
So this is actually, apologize again for getting slightly on the geeky side, but this is quite interesting.
Let's get geeky.
Yeah. So I'll throw you back into the finance courses you took at university. But
yeah,
the fact is that from an econometric or statistical standpoint, we're much better at measuring volatility than we are at measuring returns. So there are quite good forecasting models for volatility, for example, but they are fairly useless when it comes to forecasting returns. So if I make a model that predicts S&P 500 volatility, I can do that quite well, but I'm very bad at building an econometric or statistical model that predicts the stock or the S&P 500 return over a certain period of time. And volatility gives much richer data to analyze, and you don't have the same issues of non-stationarity as you have in the usual, what we call the levels regressions. So if we do some of the investigations around green bonds, and particularly with the case that we have so little data on green bonds, it's actually quite an advantage to use the volatility dimension and start measuring things from there. And it seems like the models might be very difficult. There's a whole set of models called autoregressive conditional heteroskedasticity, ARCH and GARCH, and people might remember them, but they're not actually that complicated. And you can use them, you can estimate them on something like the German Green Bund to get a number out and say, does the German Green Bund actually have lower volatility than the traditional bond? And I think this is super interesting because it gives us a really good analytical tool set to determine, are green bond investors actually being rational in terms of buying sometimes what seems to be lower yielding instruments. And it also is, there's another really cool point about this. It gives a good argument for issuers as well as policymakers to say that, we think that the volatility, we can make the volatility lower in the green bonds that we issue or that are out there. And hence we can also support the fact that they can have, lower spreads, and then they get us to be this cheaper cost of financing because we reduced volatility. So everyone's happy. And, I like that.
So let's talk more about that. Can policymakers actually reduce volatility? Because if that's the case, if we have all of these levers that we can sort of pull, if you will, to reduce the risk of green bonds, then what are we waiting on? So can policymakers, do they have that in their toolkits where they can actually reduce risk? And how is that the case?
So I'll take the liberty to become a little bit self-reflective here. And back in mid-March, I actually wrote an article where I said that when others are fearful, be greeny. And what I meant by that was essentially we saw that green bonds, as well as a lot of other bonds, were spreading out, going much wider. Yields were going up and prices falling in the midst of the COVID disaster, or in the start of this whole lengthy process. Now, I made the argument then that I thought that policy institutions like in Europe we have the European Investment Bank or something called the Nordic Investment Bank, which are these sort of supranational institutions. But policy making institutions, they should be countercyclical. They should go into the market and buy good assets such as green bonds in the midst of market volatility. And by doing so, they could actually quite significantly reduce the volatility, both the realized and the expected volatility on things like green bonds that we want to see more of. And that's a pretty strong argument, I think, where they could really be of some use in this market, to be some sense of buyers of last resort of the green assets specifically. That will give the attractiveness of holding green assets to investors will increase manifold, and that should also lead to lower cost of financing when it comes to the green side.
So it sounds like what you're describing right now is the aspiration. So we aspire to the point where these policymaking institutions will go into the market and kind of buy these good assets, quote unquote, if you will. Where are we right now? If that's the aspiration, where are we right now? And what is the spread between where we are now and that aspirational goal? And what do we need to do to get there?
So, right now, in general, there's I think a consensus that there's a little bit of a price premium or green bond premium in the market, but it's not very big. But there is some evidence to that extent. Even I try to find that and using even the more complicated econometrics. But what I really want to convey, and what made me jump a little bit around in March, but I also think we should look at going forward, is to look at green bonds not only as some sort of allocation instrument, but also a trading instrument where people can be pro-cyclical. If people would have followed my recommendations, and I don't know how many did, not a lot, I think, but back in mid-March, you would have made out like a bandit on those trades. I mean, if you go in and buy green assets at the downturn of the market, and then you sit with them until you're in the bullish part of the cycle, which we are right now, it's going to be good economics for whoever who does it. But that's really something I want to incentivize. I want to see the sustainable investing as the remit of active managers, active traders who go out and are there to be counter-cyclical and maybe also even sell off some of their assets and when they're being too expensive, etc. But that's how we grow the market really and get end investors as well really excited, because if you can outperform massively using green bonds as your sort of beta factor, and then there's no question that's going to be very popular with end investors.
So Ulf, this was fantastic. If we just go back to basics as we started in the show, whether you're dealing with green bonds or whether you're dealing with traditional bonds, this fact remains: issuing bonds at lowest possible spread yield versus on the issuer side versus investors who want as high a yield as possible is something that we're dealing with on either side, whether traditional or green bonds. Secondly, really appreciate the insight behind the green twin bonds and really looking at it from the standpoint of looking at green and non-green bonds with the same maturity, with the same coupon, and really using that use case as a laboratory, if you will, to measure properties and to really measure the different characteristics between the two. And then finally, understanding how we can find the opportunity to have lower volatility with green bonds than traditional bonds, policymaking institutions having an important role there, and really looking at green assets as a trading instrument so we can look at the incentives behind sustainability investing. Ulf Erlandsson, thank you so very much for your time and for joining us.
Thank you very much. Always a pleasure.
We invite you to subscribe to the Refinitiv Sustainability Perspectives podcast on iTunes, Spotify, or wherever you stream your content. What did you think about the podcast? Leave us a review on iTunes or follow us on LinkedIn and Twitter for updates on our show. You can even check us out on YouTube now. Thank you for joining. See you next time.